today is we're going to talk a little bit about what headwinds we're facing in the market and really how to combat the narratives that our clients are facing out there. And I believe that we are in a crisis, but it's not the crisis that you think it is, and it's not the crisis that our clients think it is. This is not a 2006, 2007 type moment, but I do believe we have a crisis in narrative that our clients are hearing, specifically from the mainstream media, as well as algorithmic based things like YouTube and Twitter, right? So we have a client and that client gets on YouTube and watches one video about how real estate prices were crashing. The algorithm goes, he likes videos about real estate crashing and shows them more of them. And then it becomes a self-perpetuating situation. So our brains are wired in such a way, if we go back to Cro-Magnon man, that things that are a threat flash red lights to us, right? And the media learned this lesson a long time ago, that fear sells, right? That's why you never read anything good in the newspaper. It's all war and poverty and everything else. So the social media algorithms have learned something very similar. And that's what our clients are facing right now. So if you look historically, owning real estate for the long term is the biggest driver of wealth in this country. And my fear and my concern that the narrative that our clients are hearing right now is going to rob this next generation of Americans of an incredible amount of wealth. And there is no one better situated to combat that narrative than the professionals that are in this room. And one of the things I like to say about, you've got lenders, affiliates, you've got agents. Agents have contacts. We can help with content, right? And so part of what I want to do today is share with you some content that you can then use with your contacts to be able to try and combat the narrative that they're hearing in the media, on social media. So I'm not saying that I'm concerned about this narrative just with my lender hat on, right? I'm talking about this as I look at this data as a real estate investor myself. I want to know, should I be buying? Should I be selling? What the trends are doing. And so I'm going to share with you some of that information that I have come across that I think will be helpful for all of you in the next few minutes. So I'm going to give you an example of some of the narrative crisis that our clients face. So these are headlines. I'm going to read you some headlines going back to 2015. Housing today, a bubble larger than 2006. And I should start by saying these are all headlines from, does anyone know who Diana Olick is? Yeah. Diana Olick is the senior real estate correspondent for CNBC. She is an expert on real estate. She is the person our clients hear the most when they turn on the television. These are articles, headlines from her going back to 2015. Housing bubble, a bubble larger than 2006. In 2016, we're in a new housing bubble. In 2017, home ownership doesn't build wealth, study finds. September 2018, it's better to rent than buy in today's housing market. July 2019, the housing market is about to shift in a bad way for buyers. December 2019, next year will be hard on the housing market, especially in these big cities. And finally, July 2021, the housing boom is over as new home sales fall to pandemic low. So what I'm showing you in these numbers over here on the right side, this is if we had in 2015 the median sales price of a home at $300,000. If we had a client that bought or didn't buy a house in 2015 because Diana Olick told them not to, they would have missed out on 5.1% in appreciation or $15,000. They listened again in 2016 because they were going to wait. They missed out on $17,000 of appreciation. then 20,000, then 14,000, then 15, then 61,000, then $80,000. So if they went back to 2015 and listened to the lead senior real estate expert on CNBC, they would have lost out on over $200,000 of net worth. This is a scary thing for a client to be up against. Now, if our clients are taking that advice, they're putting themselves, and we, not combating that narrative, are putting them in a terrible position. So my challenge to everyone going forward here is to spot these kinds of things and to try and counter those narratives, because we owe it to our community to be able to do that. So let's talk about some recent narratives. Guess who is that? Consumer yes, do not name drop me when you get it. Consumer confidence in the housing market hits a new low, according to Fannie Mae. Now, I wonder where those consumers got their confidence level from. Neither here nor there, but let's talk about the survey they asked. This was in November, last month. Is it a good time or a bad time to buy a home? People who believe it's a good time, only 16% of consumers believe it was a good time to buy. Is it a good time or a bad time to sell? Only 51% think it's a good time to sell. I don't know how you get 40% equity in the last 2 years and go, oh, that's not a good time to sell. That's okay. 51%. Here's where I think we'll talk about some data that I think will be interesting. Home price expectations. People who believe home prices will go up in the next 12 months, 30%. That means 70% of the population believe that home prices will be going down in the next 12 months. Mortgage rate expectations, now you come into my layer. Mortgage rate expectations, people who believe mortgage rates will go down in the next 12 months, 6%, which means 94% of the population believes that mortgage rates will go higher than they are today in the next 12 months. Now, look, if you think about it, a lot of this makes sense, right? Because if you saw headlines like that year after year, you're going to have a negative feel about real estate. And if you listen to people who don't understand how real estate or mortgage rates specifically work, they think that mortgage rates are based off of what the Federal Reserve has to do, then there's bound to be some fear and confusion about those numbers. So let's talk about this consumer confidence. So this is kind of the report that that article was based on. So this is what the public thinks about real estate. I pressed the wrong button. This is why we're here today, okay? This is the lowest amount, this is the lowest level on record. Now, this doesn't go back that far, but consumer confidence in real estate is hit its lowest level ever on record. And it's this is the reason you guys are sitting in this room today, because we want to change the way that you think, so you can help change the way our clients think, and we want to provide the inspiration that our clients need to confidently move forward or not move forward. Not everyone needs to buy real estate, but you need the data to be able to confidently make that decision. So that's what we want to kind of talk about. So the public thinks it's a terrible time to buy real estate. Well, here's a little headline for you. I am a firm believer of what are the billionaires doing? Okay. Blackstone puts finishing touches on a record real estate vehicle. Okay, Blackstone is got more money than decimals I know how to do with. Okay, so they believe that real estate is a good place to be. Not just Blackstone though. JP Morgan Chase. They also are coming in with a big real estate investment, $1 billion. Now, I'll just simply add this. Do the billionaires have more data, or does your first-time home buyer have more data to make a firm decision on what real estate is going to do? Okay, I don't listen to the billionaires' lips. I watch what their money is doing, and this is what their money is doing. The reality is the average consumer wouldn't even know where to start to get the data they need to make a confident decision, and that's where all of us real estate professionals here in this room are coming in. Now, the billionaires are betting on lower rates. This is going to be the most technical of all the slides that I have today. So Jeff, I'm going to try and Sesame Street this for you as best as I can. This is an inverted yield curve. And I think that financial advisors have largely created terms like inverted yield curve to get us to give them money and pay fees.
Yeah.
I lost and Google. All right, well, let's kind of talk about that. So in reality, it's a fairly simple concept. So think of a car loan. If you go to a bank and you want to buy a car tomorrow, if you want to take out a car loan for 1 year, you get a certain interest rate. If you want to take out a car loan for 7 years, that interest rate is higher, right? Because the bank wants a higher rate of return to lend you money for a longer period of time, okay? Because as an investor, if I'm a bank, if I'm an investor, I'm losing out on the opportunity to invest my money elsewhere because I have it tied up in your car for 7 years. If I have it tied up for 1 year, I get my money back, I got a little bit of interest, and now I get to invest it somewhere else. But if my money is tied up in your 7-year car loan, I don't have the ability to invest that money elsewhere. So the longer you borrow money, typically, the higher the rate is. We see that in mortgage rates. Typically, a 30-year fixed mortgage rate is going to have a higher rate than a 15-year fixed mortgage rate. It's very similar. So now, kind of switch your thought process instead of the person borrowing money and be the person lending the money, right? So in this case, I'm lending my money in the form of a bond. And as an investor, and I get a fixed return on that bond. Now, typically, it works the same way. If I invest in a bond that is 10 years long, I will typically get a higher rate of return than a 6-month bond, right? As the investor, because I'm tying my money up for the longer term. So there's the idea of opportunity cost there when it comes to not being able to invest my money elsewhere. So as a bond investor, if I get a 10-year bond, I'm going to get more money back versus a short-term bond. Think about it in your checking accounts, right? Prior to the last 6 months, what kind of money did you get in your checking account? 0, maybe 0.1, 0.2. Dave, I don't know if you guys are offering over there. Maybe you guys something there.
0.2.
Okay. So an inverted yield curve is the opposite of that. So this is when I, as an investor, am getting more of a return on a 6-month bond than I am on a 10-year bond. So in this case, it's a 10-year versus a 2-year. But when we go into these red periods, it's showing that as an investor, I'm getting more money by tying it up for 2 years than tying it up for 10, which seems weird, right? Because it's typically the opposite, right? So if I wanted to invest in a government bond, which is the most risk-free investment on the planet, it is, but I'm going to trust that we have 11 aircraft carriers and we'll pay our bills. But if you were to invest in a 10-year bond, this was yesterday, you get about a 3.6% return. So if you wanted to buy a bond from me, the government, and you wanted me to hold your money for 10 years, I would give you 3.6% interest. But if you wanted to borrow money from me for 6 months, I would give you 4.6%. Now you, as an investor, why would you tie your money up for 10 years and get less interest? Right? Why wouldn't you just take the 6-month bond, get your 4.8%, then you get your money back at the end of 6 months and go, what else can I do with it? Right? That's an odd scenario. That is not the usual thing. So when you have what's known as an inverted yield curve, you have all these people that are coming in, these billionaires, and they're buying all these 10-year bonds. They're not buying 6-month bonds. And that's what's pushing the rate on those 10 years down, because you have all these people putting their money in this safe asset for a longer period of time. Why are they doing that? Why would you, if you're an investor, put your money somewhere that's risk-free for a longer period of time, even though you're going to get a lower rate of return?
I should think interest rates are going down.
100%. Always have.
I've never got 100%. You're welcome. Whoa. Give me 20 minutes.
So this is our investors telling us that they believe that interest rates will be coming down. These are the hedge funds, your pension funds, your billionaires investing money in, telling the rest of us through a very convoluted chart that they believe that interest rates will be coming down. Now, I'll pause there just because, again, that was a very technical thing. Any questions on that piece before we move on? Okay, so that being said, I wanted to take us back just a minute because I want us to remember what we just learned. The billionaires believe rates are going down. John Q. Public believes 94% of them believe that rates will be higher. The billionaires think real estate's a great place to put your money. John Q. Public does not. Okay, so this is the narrative that, but of course, billionaires aren't going to be going out of their mind trying to let everybody else know this, right? So this is the information that they have access to. They're telling us what they believe in. Okay, and I'm not knocking a billionaire, because if I were a billionaire, I won't be here. Okay, Powerball lottery, anything else, not seeing me here.
You wouldn't be wearing pants.
Is that
We're gonna be a damn. Oh, I know that.
But that's the narrative, right, that our folks are up against. So let's talk a little bit then about the problem that all of you and I am running into. I think there are essentially 4 big problems that we face when we think about the clients that we're serving today. Number 1, buyers are uneducated and afraid, and the media is winning that narrative. Number 1. Number 2, buyers are trying to lowball sellers, right? Because market's crashing, price got reduced, it's been on the market, God forbid, 31 days. Lowball it, come in 50K low, okay? These kinds of things causing cancellations. 3, the buyers are up against something, right? Rates a month ago were 7%. Like, buying power has been reduced. That's a real thing. And number 4, sellers are walking away from a ton of money by doing price reductions when there are other strategies that are out there that they could better spend that money to serve those clients and would actually better everyone's pocket. Okay, so those are the 4 problems that I think we're up against. And I think our job as real estate professionals is to replace conjecture, replace fear, and replace it with confidence. And I would offer to you that I think by the end of this presentation, we'll have some answers for these problems. My biggest fear is we walk away from this and all you guys got was a free breakfast and some regret that you stuck around. Okay. So I want to make sure that the time that we're spending here is worthwhile. So let's find somebody to help, right? I want you guys to think about the people that you talked to in the past year. And is there anybody that fits this bill, right? Do we have buyers that we were working with that ended up not buying a home because of rates or inventory? 2, what buyers are you working with that aren't getting offers accepted and or are lowballing people and causing you guys to pull your hair out because you're writing offers that you're embarrassed of? 3, what homeowners that you talk to express an interest in moving, but just decided, I want to step away. And 4, are you working with a seller that's contemplating a price reduction? Think about those 4. If you got anybody in your client base that fits this bill, let's see if we can solve some of those problems so you can circle back and maybe present.
Check.
Oh, yeah, right. Everybody I talk to seems to have some going on with it. So I want you guys to kind of think about that, and I want to persuade you to try and be willing to go back to those people and say, hey, you know, the market's changed a little bit. Are you willing to take a second look at this? And if you need to partner with your favorite loan officer, whoever that is that you work with, look, we all have access to this kind of data, and everybody is more than qualified to do that. So let's talk a little bit about mortgage rates, because I think that mortgage rates really, going back to this one, right? Purchasing power has been decimated. That purchasing power has been decimated because of mortgage rates. And what the media typically, and any loan officer in this room can tell you, when the Federal Reserve cuts rates, the Fed funds rate, which we'll talk about, their phone blows up. At the beginning of COVID, when the Fed funds rate went to 0, my phone would not stop ringing. Can I have a 0% mortgage? Yeah. Yes. Like, we want to talk a little bit about what is driving mortgage rates, and I'll Quentin Tarantino and bring it to the end, and then we'll bring it back, right? Inflation drives mortgage rates, okay? When inflation is trending up, mortgage rates trend up. As inflation peaks and starts to come down, mortgage rates come down. So let me give you an example to kind of demonstrate this, right? So let's say you are a mortgage investor, okay? I am a client. I want to buy $1 million house. I'm asking you to lend me $400,000. I have a 780 credit score. I have plenty of money in the bank. A year ago, would you say that 3% would be a fair amount for you as an investor to get 3% and a risk-free mortgage? Okay. So Eric, as the investor, has lent me $400,000 and is getting a 3% interest rate. And then all of a sudden, inflation starts to go up, okay? So now the money that I'm giving him is, he's getting that money, I'm paying my loan on time, but the things that he can buy with the money I gave him, all of a sudden becomes eroded, right? Because let's say inflation goes to 8%, as it did, right? So he's lending me at 3%, I'm paying him at 3%, but his gas, his groceries, all the things he can buy with the money that I'm giving him is going up by 8%. So now he's losing money left and right because the money I'm giving him is not keeping up with inflation. So now you say to yourself, you want to lend money again, and John wants to come and borrow some money. Now that inflation is 8%, are you going to give him a 3% rate, or are you going to give him something higher? You wouldn't give him that rate, we're going to have So when inflation goes up, the amount of money that an investor receives on their investment, it is eroded. What they can buy with that $2,000 a month that I'm paying him goes down. So as a result, the next loan he's going to give out is going to be higher because he's got to at least keep up with inflation. Okay, so that 3% rate that he charged is completely eroded. So we have to charge a higher interest rate. So let's kind of talk, first off, just a real basic idea of what is inflation. Inflation is too many dollars chasing too few products. My favorite example of this, and I'll turn it back to a house in a minute, but my favorite example of this was, I don't know why everyone went crazy about toilet paper when COVID started. Okay. People were willing to pay like $10 for one roll at the gas station. The gas station was pulling apart the 6-packs and selling the one roll. I'm like, did you read up on this virus? Yeah. Understand why we're doing this. But the idea is that we had too many dollars. Everyone had money to spend on toilet paper, but Costco only rolled one pallet out this month and everyone went crazy over that, right? And so if we turn that into real estate, we had too many buyers with interest rates offered at 2.5%, 3%. We had too many buyers chasing too few homes because nobody wanted to sell their house in the middle of a pandemic and nobody knew what was going on. And as a result, this is pushing the value of homes way up, right? So you've got this guy right here. This is a Bitcoin millionaire. Okay, this guy right here, he wants to buy a house. This guy is a tech stock. He works at Amazon, gets all this restricted stock units as his income, and then this guy's a veteran. He's getting a 2.25% fixed, 100% financing loan. All three of these people want to buy the same house. Doesn't look like a house, but it's pretending it is, right? Well, then all of a sudden inflation starts rearing its ugly head. Well, as soon as inflation started, your Bitcoin guy, he's in trouble. Because although that was supposed to be a hedge against inflation, the value of his Bitcoin went way out. So he said, yeah, I'm not interested in buying a home. His tech stock has gone way down. So all of a sudden he doesn't have as much available for a down payment. So he might go, yeah, I'm going to step away. I'm not going to try and buy a home. The veteran is like, shit, man, I can't afford a payment at 7%. I was good at 2.25%, but 7%, I can't do it. So when the Fed came in and raised rates to fight inflation, it hit the Bitcoin guy, it hit the tech guy, it hit our veteran. This is called demand destruction. These people no longer want to buy a house. So now you have 3 fewer buyers wanting to buy this one house. So the Federal Reserve is trying to come in. They see inflation is starting to get out of control because you've got all this stuff back up in China. They couldn't deliver all the stuff on the ships. You couldn't get a microchip. You couldn't get a stainless steel refrigerator. You still can't get a garage door. All these things. The Fed comes in and says, we need to slow everybody down. And so the Fed raises the federal funds rate. And the federal funds rate is the rate that banks lend money to each other overnight. That's what that is. So for example, if I'm a bank and Eric here has a car dealership, you got a lot going on. You're a car dealership. He has a car dealership. He's like, I'm getting out of the car dealership business and I'm going to withdraw my $20 million that I have on deposit with you. While at the same time, I lent Edwin $20 million for some real estate venture that he goes on. Well, I'm a bank now. I'm like, oh, crap, I'm out $40 million in one day. Sometimes I have to borrow money from another bank just overnight. I just got to move some stuff around. I got to check it in the savings and got like stuff going on. So I'm going to borrow overnight money from another bank. That's what the federal funds rate is. However, the federal funds rate is also tied to some really important things for all 3 of these people. Number 1, it's tied to the prime rate, which is what your home equity lines of credit are tied to. So your HELOCs, your credit cards, your business loans, okay? All these things become more expensive. So as credit cards become more expensive, the interest rate, the minimum payment that someone has on a credit card, I'm not going to talk about Americans in general, but a American who's doing a really good job with their money, would they be more likely or less likely to spend money on the credit card with a higher rate? That's good. Now the reality is they just spend regardless. They max out the credit, and then they can't do anything. But the idea is a higher interest rate is going to get someone to not put that money on the credit card, which means I'm not going to go to the movies. I'm not going to go out to eat. I'm not going to buy that new fridge. Okay, so we're going to slow down some of the demand we have for these things over here to try and bring down inflation. Same thing if you're a business. If you're getting a business loan at 2% and you want to open up a giant manufacturing plant, I can do it when rates are 2% if I'm a business. But if now all of a sudden rates are much higher than that, I might start to go, yeah, I don't think I'm going to open that plant over there, or I'm going to pause on it until rates come back down. So now you've got that plant isn't opening. So we no longer need those jobs at that plant. And then when those folks get laid off from their jobs, are they gonna spend more or spend less? Less, they're gonna spend less, right? So all these things are coming in to try and slow down demand on everything, right? Whether it be gas, whether it be real estate, whether it be stainless steel, microchips, used cars, whatever it is. The idea is the Fed is gonna come in, they're gonna raise rates to try and get us all to put our money in our pockets and stop spending it, right? And by not spending it, this allows the supply chain problems to kind of ease themselves. If it takes a little longer to get a microchip from China, no problem, no one's buying them anyway, right? So that's the idea of what they're trying to do. In addition, they are trying to get you to put your money in the bank. So now compared to a year ago, you're getting a much higher interest rate on your savings accounts. I just moved my own money to a bank that is offering me 4% on all of my savings accounts. I'm like, 4%? Okay.
Wow.
For as long as I have it. You sure that. So the idea, there's been studies done that shows that if a human being receives more than 2% return on their savings, they'll keep the money. But if they earn less than 2%, they just rather spend it. Right? So now the Federal Reserve, by getting the banks to give you more money by keeping it in the bank, you're less likely to spend it, which again is going to help bring down inflation. It's going to loosen up those supply chains. There's going to be more goods and services, toilet paper available for you guys. So when you have, now you've got you've got 3 people chasing 2 baskets or 2 homes, you've got more choices. That's why our buyers can go and they don't have to put in an offer of a 24-hour close or something with $50,000 over asking, no contingencies, right? Like that's not really where we're at. And that's what the Federal Reserve's goal is to bring this stuff down because prices were getting out of control. Now, I'm not going to pat them on their head too much. I'm going to rip them the rest of this presentation. So hold tight. So talking about inflation driving mortgage rates, we kind of talked about why. Let's look at the data, okay? So this top line here is the average mortgage rate over time. So we go back to early 2018. This bottom gray line is inflation. So obviously it's not directly tied to one another, but you can see they generally go in kind of the same direction, right? Until we get into this period right here. This is known as quantitative easing. And what this is right here at the beginning of COVID, right? Everybody gets laid off from their job. No one can go outside, all the things. Well, of course, inflation comes down because no one's buying anything other than Amazon, right? God bless those Amazon guys still coming to my house multiple times per day during this period. I just want to talk to them. So needless to say, inflation drops off, right? Because no one's spending any money. But then the government, in order to stimulate the economy, they do what's known as quantitative easing. So one of the things they do in doing this is they come in and they start buying all the mortgage-backed securities they can get their hands on. So I, as a mortgage-backed security investor, I was getting like, I don't know, 4% right around the beginning of COVID, right? I was getting, that's what I, as an individual investor. Well, now the government comes in and goes, hey, who wants 2.5? Because I will buy your mortgage-backed securities for 2.5. Now, Eric, the home buyer, is he going to want to borrow that money from me, the individual guy that's running off market forces at 4%? Or are you going to go, hey, I'll take the government and just have my money for 2.5, right? You're going to take the 2.5. So in this period, all of a sudden, everything gets a little sideways. Mortgage rates come down and inflation started to come up. And the term they used was inflation is transitory. That was the word they kept using. In other words, the supply chain is going to loosen up and that's why everything is higher. Don't worry, it's going to come down. So they kept their foot on the gas, right? They kept offering super low mortgage rates, which, hey, I'm gonna be honest, we all took advantage of. Okay, we all had a great 2021.
Yeah.
But inflation is starting to get out of control, right? And they kept going, no, it's transitory. Well, right about the end of last year, they come out and say, okay, maybe it's not transitory. Maybe it's a little stickier than we thought. So what we're gonna do is we're gonna stop buying those mortgage-backed securities. So now the market takes back over. Inflation is through the roof. Me, John Q. investor, who's investing in mortgage-backed securities is like, dude, inflation is up here. I can't give you 3%. So then rates start going up. And over time, the Federal Reserve, because they don't just stop on day one. They go, okay, this quarter we're gonna buy a little less, a little less, a little less. Well, then mortgage rates get out of control. Doing what? Following inflation. Okay, so that's where we got to in terms of how these things are tied together. They move in a similar direction. So when the Fed was kind of rigging up, when the Fed is rigging the game down here, not only did it cause all of this, right? Because stimulus money is in the economy, everybody's got all this extra money in their pockets, they're spending all this, it's causing this, but they're not letting the market follow suit to allow it to be a nice gradual increase that we've been used to over time. Instead, every loan officer logs into their computer every day and like it is like it's so it for 2 years it was like my favorite thing, like, ooh, wonder what rates got down. I mean, all year I've been like, I want to go to work because every day it would be significantly higher. We would just be like bang, bang, and it's just like I quoted somebody last week and they weren't happy with that rate. Wait until I call them back. Yeah. Or wait until I call my realtor partner who I'm like, yeah, sorry, they lost $20,000 in purchasing power today. Right? So these things are what's happening because the Fed was putting their finger on the scale. Now they've stopped that. They realized the error in their ways as they are wont to do they're usually late. But let's then talk about if we can see by this chart that as inflation goes up, mortgage rates goes up, that should mean that when inflation comes down, mortgage rates should come down with it. So let's talk about when that should happen. So this is what's known as the core CPI report. And this is a report that comes out each month. And it tells us how much inflation we had the prior month compared to the prior year. So the way that this report is put together is they add up the last 12 months and then they come out with one big number. That's the big number you see on the news, okay? The report came out this morning. We were at 6.3% year over year. We are now at 6% year over year. Every mortgage rates are celebrating this morning, okay? Rates are having a good day today because inflation was better than expected. But the important thing to understand about what's going to happen in the future is to understand how this number is calculated. Okay, they take 12 months and they add each of these numbers up. Okay, and the reason that I took this out back to July of 21 is because to understand why rates went up, you have to understand what was being replaced. So if we go back to the July of 2021 number, inflation, core inflation was 0.3%. Then in July of 2022, that's actually not a great example, 0.3, so it was flat. But if you look then here in August, you were at 0.2. Over here, it's 0.6. Okay, so the 0.2 falls off and is now replaced by 0.6, which pushes the headline number up by 0.4. So now that's, oh my God, that's a lot, right? And so the markets explode, interest rates go up. The reason I want to show you this longer term is because the Fed's goal is to have this number come in at about 1.75 or 0.2. Okay, that's the goal, is to have it around this level. But if you look at the last 12 months, this is the number we've been working with. Okay, this is actually good for us now because as you've seen today, great number, 0.2, what the Fed wants. Last month, 0.3. Last month on this day, when this report came out last month, it was the biggest one-day drop in mortgage rates in recorded history. So rates went down by 1% in 1 day because the market was so happy to see this number because the October of 22 was 0.3 and the October of 21 was 0.6. So the key thing to see here is all these numbers are high. And as the Federal Reserve has slowed down our economy, the numbers that will be replacing them should be low as we move forward. So if we can keep getting numbers like we have the last 2 months, 0.3, 0.2, replacing 0.6, 0.5, now the overall number, we get rid of another 0.6, another 0.6, another 0.5. Each month we get this report, inflation should be coming down even lower. And so that's why this is not, to me, this is not a 5-year problem. This is not a 10-year problem. This is like a 6-month problem, maybe 9 months, before we get all these big numbers to come off the report, getting replaced with numbers like this. And once we get, because this is what it used to look like, right? When the market was operating normally, we would get numbers like this. And if we can get numbers like this each month moving forward, it will bring the headline number down, people will rejoice, mortgage rates should come down with it. And one of the things, though, that is also unique is that when the Federal Reserve raises rates, when I go back, yeah, one thing. Thank you. We go back. When the Federal Reserve raises rates, it leads to a recession. Okay, these gray lines going up and down are recessions. Right. So if we go back all the way to 1955, right?
Yeah.
Raise rates, gray line, raise rates, gray line, raise rates, gray line, and on and on and on and on. I don't know how they predicted COVID, but raise rates, gray line. Okay, what are they coming down? Raising rates. What should that give me? A gray line, also known as a recession. Okay, so if the Fed is fighting inflation by raising rates to get people to spend less money, that typically then leads us into a recession. And you can see this all charted out. Now, are we in a recession now? Probably, but they keep moving the goalposts, right? Like it used to be 2 straight quarters of negative GDP was a recession.
Yeah.
And then they're like, oh, it's not really a recession. And it's like, look,
We're not ready to make that announcement.
yeah, correct. We haven't decided that it's a recession yet. So
Normal.
yes, which we'll talk about, because 2008 was a very unique to us scenario. And I'm glad you asked that, because that's what most people feel. Like they think that when recessions happen, housing prices plummet, everyone loses their house. There's many reasons why that's not the case, and we'll kind of talk about that. So if we think that Fed rate hikes lead to recessions, what else could possibly lead to recession? Anybody remember this chart? Yield curve inversion. We go back and this red line right here, every single time the yield curve went under that red line, what follows? Recession, 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 recession. Well, guess where we are? We're under the red line. Okay, so if we have the rate hikes suggesting a recession, we have the billionaires inverting the yield curve, telling us that there's a recession on the way. It suggests that there's a decent chance of that. Here's some more data. This is what's known as the LEI report, leading economic indicators. This is kind of a report that takes a bunch of different things together and measures where the economy is at. So manufacturing data, unemployment rate, building permits, credit conditions, stock prices, and then some other things. They add them all up, 10 different things. And when it reaches right below 0%, again, 100% of the time, inflation or recession, 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 recession. Well, guess where we're at? Right here. So as these things continue to get worse, manufacturing data is unlikely to get better if we're not spending as much money to manufacture things, right? As this number goes down, again, we're likely headed towards a recession. People always say, well, look at the unemployment rate. The unemployment rate is really low. Can't be in a recession with an unemployment rate that low. Well, let's look at where we've been. These are job creations. The average month in 2021, we created 562,000 jobs. Over the last 12 months, we've been creating 442,000 jobs. Over the last 6 months, we've been averaging 347,000 jobs. Over the last 3 months, only $289,000. I wish. Anyway, I wish I had $289,000. 3-month average is 289,000 jobs created. So this is slowing, right? Jobs are still being created, but it's slowing. And if you kind of look at it, I'm just asking, what do the billionaires know that we don't know? What do the tech companies know that we don't know? Tech companies have more information than anybody on the planet. Okay, they see what you do on your phone, your Alexa listens to you, all kinds of other things. Siri knows every little dirty secret you've got. And look at what they're doing. Amazon cutting 10,000 jobs. Twitter, kind of a unique scenario, but they cut a bunch of jobs. Facebook, 13% of its staff. Nobody goes on Snapchat, so that's explainable. Shopify, Netflix cutting jobs, Microsoft all the way down. Apple and Google have either paused or slowed down their hiring. So all these tech companies that have access to unlimited amounts of data are telling you that the economy is slowing.
And I'm just going to point out that Shopify is like the leading servicer for online stores. So if they're like back and they're like the lead,
It's kind of a canary in the coal mine, right? Because they're getting, I assume they probably get a cut per transaction, and they're seeing fewer transactions. Now all of a sudden they've got to lay people off. I think it's a great point. So you've got all these tech people that should be ahead of the curve with all the data they have access to, telling us that things are slowing down. Everyone tells you again that when you can't have a recession when the unemployment rate is so low. How can you have a recession when unemployment is 3.2 or whatever it is, right? And recessions don't start when unemployment is high. Recessions cause unemployment to go high, right? So again, if you look at all the vertical lines again are recession, they start when unemployment hits the bottom. Then the recession itself causes unemployment to go up. So we're now at a point where we still have lower to go? Maybe. I mean, they don't think so. This average doesn't say that that's the case. Go ahead.
All right, so the jobs report seems skewed because wherever you go, it seems like no one can find anyone to hire. So if they're reporting that it's low, that doesn't seem to correlate. Like it's low, but there's no good help out there. So it just doesn't seem true to me that the government is just paying workman's what do you call it? Unemployment to everybody. Still, that has to run out.
It does.
So it's never been explained properly to me. Like I don't know if you have anything.
Yeah, absolutely. And I think it's a great point because I think that if that problem did not exist, the number would actually be going a little higher, because what happens, the way that they calculate the number is they don't count people leaving the workforce who are not actively searching for a job. And the definition of that is someone who has just stopped filling out the little weekly thing for unemployment to get me my check, right? That's not to say they're not willing to work, although a lot of that is. But you've got a lot of people who are working 2 jobs, right? And a lot of that goes into the numbers as well. Because if you're an employer and you employ someone over 32 hours, you've got to give them benefits. So they're like, I'd rather hire 2 people working 20 hours a week than pay benefits, right? And so those people aren't counted in those numbers either. So there is absolutely an issue with that, but the percentage doesn't count the people who they say are not looking for work. So if you're somebody who wants to work, but you don't want to work at McDonald's because the pay is too low, but you're not necessarily qualified to get a job somewhere else, or you're just going, I'm not going to work for that, one reason or another, you don't get counted. You get taken out of the percentage, like the number that they're doing the dividing out of. So that's it's in a lot of ways artificially keeping the job number low, and as far as the unemployment rate is concerned. But the other part of it is the report that they like to politically point to a lot to say, look, the economy is great, is what's known as the JOLTS report, which is just counting the actual physical number of employees. But you can get double counted, right? If you've got to work 2 jobs to make ends meet, they're counting that person twice and going, look, you guys look at all these people employed. It's the same person got 3 jobs, one was an Uber driver, right? And I think part of it too is also goes into, I'm not necessarily looking for a job, if I'm driving Uber or DoorDash or whatever, that's self-employed. So it's a little different, so all of that kind of plays into how that number is calculated, and there's always noise in there. That if you dive deep into the report every week that it comes out, as far as job creations, or every month for the unemployment rate. The reason it stays low, because otherwise, if you create all these jobs, you would think that, hey, that number should be going lower. Look at all those people who got jobs. But you still have a bunch of people who are saying, I'm not in the workforce anymore. And COVID actually, and a lot of them are coming back, but a lot of people were just retired at COVID. Like they're just like, oh, I don't have jobs for it. I'm good. And they just stopped working. Like I know a lot of people in the mortgage business who are just like, I don't feel like dealing with it. I'm like, you're stupid because the rates are super low right now. It's okay, I'll take your clients. But the gist of this is just trying to say that recessions don't happen when unemployment is high. They happen when unemployment is low. And when unemployment is low. Now, could it go lower? Sure. But the data suggests that it's not, because those job creations are slowing down. So again, this is 100% accuracy. When the unemployment rate bottoms, recession follows. So then let's talk then what happens to what's most important, near and dear to my heart. What happens to mortgage rates during recessions? Okay, again, vertical line recession. In 1980, prior to my birth, I only heard about this as a rumor. Rates went from 16%, 12%. 1982, 18% to 13% during a recession. Whatever this is, 91, rates went from 11 to 9. 2002, rates went from 7.5 to 6 3/4. 2008, housing crisis, rates went from 6 to just under 5. And then during COVID, rates went from 3.75 to 2.75. So during a recession, mortgage rates improve. That should be, given all the data that we've suggested that a recession is coming, that should mean lower rates are also coming, should that continue. What happens to housing? This is the one that gets people. This is where the narrative goes wrong, because this is what they remember. This big recession, which was caused by me. Okay, I did stated income loans, all right? I don't know if any of you have ever seen the movie yet. Okay, Christina, it was Christina's fault. If you guys have never seen the movie The Big Short, I highly recommend it. Because the idea of the example they used in the movie was exotic dancers owning like 5 rental properties. I'll just say bartenders. Okay, a bartender with 10 rental properties just told me that they made 300 grand a year, and I went, oh, sure. Here you go. Here's your 9th rental property. You come back for more. Okay, that was at 100% financing. Yeah, absolutely. You don't need anything down. Okay, this recession was caused by housing. This recession was caused by housing, and as a result, the bubble burst. But if you look at every other recession since then, real estate has either remained flat or done well during a recession. This is the kind of data your client who says, nah, we're going to enter a recession, so this is going to happen, needs to see, right? Because could it happen? Sure. I'm not here to tell you that this is a guaranteed investment forever, but data suggests that we're okay and housing will remain okay through the recession. Now, the question becomes, how did we get here? Now, some of you guys have seen this chart from me before. I'm going to show it again, right? So in this particular chart, you've got the blue line, which is household growth, which is Eric lives at a house. He has 2 daughters, Eden and Ivy. Eden and Ivy turn 18. They leave the house. Now we have 3 households. That's a household formation, right? You get married, you leave, you're not living with your parents anymore. You've got a household formation. So this blue line represents growth of new households in America. The orange line represents completions, brand new homes being done by a builder, okay? Builder comes in and finishes those completions. We go back to 2006, 2007, okay? We had people in here, okay? We had orange bar going above the blue bar, means we were building more homes than we were creating households. Well, then, look what happens, boom. Blue line falls off the cliff. They're still building way more homes than you had people who needed them. We move forward, guess what's happened? The blue bar has outpaced the orange bar again, which means we are having more households created than houses built. So in other words, we still have a supply problem that exists because our population is growing. Now, if you ask how did we drop off on this blue line? Let's look at this. This is important because 33-year-old is the average age of a first-time home buyer. This is the average age someone buys their first house. Okay, so here everything's great. You get baby boomers, a whole lot of y'all getting born. Then we have the beginning of Gen X. Okay, and this right here is your population of 33-year-olds in 2006. We had the most homes being built while having the fewest amount of first-time home buyers. Now, if you take 33 years away from 2006, you get to 1973. Anybody know what happened in 1973? Roe v. Wade. Okay, so you've got abortion is legal, birth control is legal, all of these things are happening. Of course, you're going to have a little bit of a drop off in the amount of human beings born. Well, guess what? It's continued to come back up. Here's where we are today. Okay, we have a lot of people coming, right? We got a lot of households to be formed on the supply side. So we're not going to have a fall off from the demand side because we still got all these people need houses. And the builders, on the other hand, this is how many households they were building in 2007, 3.8 million new houses built in 2007. Today, 1.28 million new houses. Now, the great thing or the bad thing about builders is if they start to see things slowing down, which they are right now, what do? They stop building. They go, yeah, I got that dirt, I'll hold on to that dirt over there, and once I don't have to give away $10,000 and plus in seller credits, I'll start building again. But for now, they have the ability to stop and start. They have no desire. They have no desire to make this equal. Because once you make it equal, buyers and sellers should be on an even negotiating playing field. They don't want it to be equal. They want to be in control. They want to be able to control giving out commission to some of you guys on the agent side. They want to be able to control what lender is being used. They don't want to give out seller credits. So they can just stop building. So they stop building, and yet we have all these people coming. Supply is still a problem. And as long as supply is still a problem, it's supportive of prices. This is 2007. We have 116 million households formed, 130 million. And we'll get a new number. This is from last year. We'll get a new number in a month or so. 130 million households formed. There's just the supply, or excuse me, the demand is still going to be there. We have 14 million more households than we did in 2007, and we have 2.5 million less homes being built. There's still a supply problem. So if we say that builders constructed 1.3 million homes last year, 100,000 of them are destroyed. So not the new homes, but a lot of times old house gets condemned, you raise it, or you take grandma's house and then you put a fourplex on it, or whatever the case may be. About 100,000 of them are destroyed annually. So last year you had 1.2 million houses being built, and in the last year, for the most part, builders were pretty active, but we still had 1.7 million households formed. So we still had more people needing housing than we had homes being built. And you can't force, the Fed can't do anything about builders building homes. Like, you can't make them build homes unless you want to just all of a sudden the government comes in, and I'm sure it'll be real high quality. Having the government come in and build homes. So this remains a problem. Now, a lot of your clients will say, well, 2007, if we have a recession, we agree a recession's coming. Everyone's gonna lose their job, which is gonna cause everyone to lose their house. It's gonna flood the market with foreclosures, and I'm gonna buy for pennies on the dollar. Well, let's look. Okay, January to January foreclosure activities. 2022, we've had 164,581 foreclosure filings. Okay, it's a little ways off. I'm not great at math, but that's about 10% of the amount of foreclosure filings. So, and a lot of these I think are backed up from here, right? Because if you remember, we had a COVID moratorium on foreclosures, banks weren't even allowed to foreclose.
And they're still using that as clickbait. Like,
Oh.
foreclosures at all time.
Double.
Yeah.
Up 250%, but we weren't even allowed to, but that is, and like, if you especially go on YouTube, like, they flash this out, like, it's like the cover frame, and people are like, oh my God, and they won't even watch the video. And they just go, oh my God, they just see percent, they're just looking at percentages. If I were to go, yeah, foreclosures are actually 10% of what they were before, nobody likes that, that's not exciting, that's not it, right? So if this is the case, and as any lender in this room can tell you, it's a lot harder to get a loan today than it was in 2006, right? So the people who own homes now have a couple of things going for them. All right, if you are going to lose your home because you lost your job, you still have to live somewhere, right? So there's a couple of things that are in play here. One, most homeowners have gained somewhere in the range of about 40% in equity in the last 2 years alone. Now, yes, has the market cooled? Absolutely. Probably may not get 40% today, might get 35 if they have to sell it today. Why would they foreclose? They're 35%. That's not a foreclosure, that's just, I'm just gonna sell it, right? The other piece is that the people who we have been giving loans to, they have, if you are gonna foreclose or sell, you gotta live somewhere. And if you have a mortgage at 2.75%, probably cheaper than anywhere you could rent. So if you're thinking about it, you're going, okay, well, I may lose this car, but I still gotta have somewhere to live, right? So those people still have to make strategic decisions about keeping a roof over their head. So there's no data that suggests that even if there is a recession, and even if unemployment were to get to, I mean, I think it capped out around 10 or 12% during 2007, 2008. I don't think anything pointing to anything that bad, but even if it did, how do we 10x this number? Like, what scenario? These people are not bartenders with 10 rental properties. Okay, these are actual people living in the homes. So I just don't see that. So one of the things that a lot of people will tell us as clients is that I'm going to wait to buy. Okay, so that's fine. If you think that you either legitimately don't feel comfortable about paying a mortgage payment based on 6.5%, I'm not here to shop with your wallet. However, I need you to understand something. Fannie Mae came out and said they believe that rates will fall to 4.5% next year. Now, what happens when rates go to 4.5%? It's a free for all.
Influx.
Correct. Now, everyone who just decided, yeah, I'll just sit over here on the sideline goes, oh, I like that payment. Comes rushing back in. So now as a buyer, you have two choices. You can buy a home for a fair deal today. Buyer and seller are on a fair level playing field. You can choose that today and pay a mortgage payment and rate that you're probably uncomfortable with. Or you can wait and you can go right back to where you were last year, where you're fighting with 15 other people over the same house and you're getting 21-day demands for escrow with no contingencies and all the things that go with it. You're going to pay on one side or the other. You just have to decide which one it's going to be. So being able to educate our clients with what's gonna happen if we think mortgage rates are gonna come down, that's gonna bring more buyers into the market. That's more competition for the buyers that are out there right now that can still qualify. So we have to be able to educate them that you gotta pay on one side or the other, right? Those who buy and wait instead of wait to buy are wealthier than those who wait to buy, okay? Yeah, thank you. So in California, over the last 5 years, the person who owns their home free and clear have increased the value of that home by 63%. Now, that's if you bought your home free and clear. If you leveraged it with a loan, if you put 10% down, okay, 10%, if you put 10% down on a $500,000 loan, you've invested $50,000, but you got 63% on the entire value of the house. So you're 9xing your return on investment. That's what's really important from an investment. For people who are looking at it, not just as shelter, but as an investment, you have to get them to understand the leverage part of it, because their investment is their down payment. It's not just, because if you go, oh, well, on average, over 100 years, homes have increased in value about 4% a year. Their financial advisors are, dude, I can get you 8% on a mutual fund. But why would I buy a house and I only get 4% when I can get a mutual fund and get 8%? You can't take out a loan for a mutual fund. You can take a loan out and just leverage the difference. And that's how people are really truly gaining that net worth, because they're not paying cash. 65% of homes in America have a mortgage on them. So they're actually returning much, much more than that. And it's important that we be able to share that and educate folks with that. 1991, 300% in California. Or is that the number? 319% higher from 1991. I guarantee you that is doing better than my mom's 401k. Okay, it just is. And she doesn't own her house. So if you look at, again, I like to follow what the billionaires are doing. Okay, some of them. Let's look at net worth. Okay, real estate drives wealth in this country. Okay, if you want to be in the top 1% of Americans in terms of net worth, you need about $11 million. I'm a little ways away. Top 2%, you need 2.5 million. Top 5%, 1 million. Top 10%, 800,000 net worth. Top 50%, $500,000 net worth. This is what struck me. Of all the wealth in America, 2/3 of it is from home equity. So if somebody's got a better idea, please let me know. Because otherwise, I'm following these people, because that seems to be where it's all tied up. Success leaves clues, right? And we have to be able to find them. We have to be able to share them with our clients.
So all those Yeezys I bought, I can't.
That's not part of that level.
Maybe now we're having some struggles with it. Yeah, I don't know what they're called. I read something yesterday on the side note that somebody wished that Britney Spears' dad could get control of Kanye to kind of get. All right, that being said, I want to honor you guys' time. We're running a little bit late, so I won't dive into the buy down scenario too much. We reported our finance forum diving deep on these buy downs as a way to mitigate these higher interest rates. There's a couple of things I just want to mention in terms of how you want to present these to your buyers. So the way that I like to present them is the seller is helping to subsidize your payment. Okay, so talking about the idea of a temporary buy down, the most popular one right now is a 2-1 buy down. So if the rate today is 6.5, for the first year, their payment is based on 4.5. For the next year, it's based on 5.5, and then the next year for the final 27 years, it's based on that 6.5 rate. But what happens is we get the seller to provide us a lump sum of money. It sits in a custodial account that belongs to our buyer. And the difference in payment from 6% to 4.5% is pulled from that account every single month. And so selling it as the seller is helping you subsidize that payment is a way to kind of get over the, "Ooh, I don't really like that payment." Because if rates come down and they want to refinance that temporary buy down, the money that's in the account comes back to our buyer. So it's not wasted money. It's not like points where you're like, I paid 2 points to buy my rate down and it's there forever. When in 6 months, I can give you a better rate than that for free, right? So there's a couple of things I just want to touch on that. Again, there's a recording from last month that dives way deeper in how to present this. But the thing that I've been getting some questions on, that I think is important for you guys to note as agents, you want to do a 1-1 buy down, okay? That's where you get 1 year of reduced payment. The seller needs to present us with about a credit of about 0.75%. We want to do a 2-1 buy down, we need about 2.25% seller credit. And if you want a 3-1 buy down, you need about a 4.4% seller credit. So depending on how much credit we can get, the idea here is don't have the sellers reduce the price. Have the sellers give a credit to the buyer to help with their payment. Because that's what buyers are feeling icky about. It's not the price, is the payment based on that price. So if we can get the seller to credit us some money to go towards that, it helps to ease some of that anxiety. So those are the 3 numbers for you as agents to kind of keep in your brain: about 0.75, 2.25, and 4.4%, depending on how much credit your loan officer can take that and then turn that into a buy down scenario.
Quick question,
Yes,
debt ratio is calculated based on the full payment?
Yes.
Or based on
it
the?
is based on the full payment, absolutely. So if rates are 6.5, buyer has to qualify at 6.5. So I have a lot of clients that can, like, "Yeah, I can qualify, but I don't want to qualify." Right, and so in those scenarios, it's like, okay, well, we can have the seller subsidize this, and if I present this data to them that suggests a recession is coming, inflation is coming down, and rates are getting better, I'm then presenting them with, hey, we have a refinance option coming at some point in the future, and the money that's still in that account, if you give me 12 grand for a seller buy down and I spend 8 of it in the first year, there's still 4 grand left in there. That comes back to the buyer, that just pays for their refinance too, right? So there's just, to me, it's a better strategy. Now, if you have a buyer that is just knee deep into YouTube, that's like, rates are going higher, even after everything I showed them, that's okay. We can get the seller to give you a permanent buy down. If you want to pay those points, you should be happy to pay the points, right? Because you think rates are going to be higher and elevated for the long term. So regardless of what the viewpoint is of our buyer, we have a solution for them. We just have to be able to get it there. And so if you're a listing agent, before you reduce the price, let's try this. See if let's give it a shot. And not every loan officer knows how to do this. Most of our local ones here absolutely do. If you get, like, I always say no offense to Rocket Mortgage, but I don't care if I offend them. The Rocket Mortgage people, like, they're not gonna know what this is, right? So the majority of people who are seeing your listing will know what to do with that. And if not, have them call one of the loan officers in this room, and they will happily walk them through this. So the only caveat I'll give you that I think is important for agents to know as well is the maximum seller concession. This is the maximum amount a seller can give the buyer. What that is depends on your buyer's loan type. If they're buying as an investment property, seller can only provide 2%. If they're putting less than 10% down, or excuse me, more than 10% down on a conventional, the seller can contribute 6%. Conforming with less than 10% down, they can only give 3%. And jumbo, it depends on the investor, but most of the time they allow 6%. FHA, VA, much higher. You got plenty of room on those. So that's kind of where we're at. These are some examples of how that works. I won't dive into that. Just out of respect for your time. But again, just thinking back, let's find somebody to help. Okay. We're recording this, so we'll put it on YouTube to try and get. I'll put it on my Facebook. If you guys want to go come back and watch again, anything didn't stick, you guys can follow it. And
Thank you, Eric.
I need to grab it. Yeah. Now what do you guys?